Be genuinely well-informed. Today, we're plunging into a fascinating, yet often unseen, engine of the global economy, the world of dry bulk shipping. Imagine a vast, interconnected network of vessels silently moving the raw materials that fuel our industries and feed our populations, iron ore for the steel that builds our cities, coal for energy, grain for our tables. It's a huge, high-stakes environment, always in motion, always responding to global demand.
And that's exactly what we're digging into today. Our mission is to take a really close look at Genco Shipping and Trading Limited. They're a publicly traded dry bulk shipping company. You'll find them on the NYSE under the ticker GNK. We're going to navigate their core business strategy, delve into their recent fleet changes, analyze their, complex financial landscape, and critically examine the diverse and pretty significant risks they themselves highlight in their own official reports.
Yeah, our aim for you, the listener, is to gain a clear, objective understanding. We're distilling the key insights directly from their financial filings, specifically their detailed 10K reports, and we've got some market data to round it out. This isn't about, opinions or biases, positive or negative. It's purely about what the documents tell us. We're basically presenting the picture as Genco paints it in their own disclosures, giving you a shortcut to really grasp the complexities of operating in this global maritime sector. So, let's unpack this. Okay, let's start by anchoring ourselves in what Genco actually does. Where do they fit in this huge dry bulk shipping world? At its heart, Genco Shipping and Trading Limited, they're incorporated in the Marshall Islands, by the way, specializes in moving major and minor bulk commodities across the globe.
Right. Think about those massive raw materials that underpin everything. Iron ore for steel, coal for power plants, grain for food, even finished steel products. If it's a dry bulk commodity, chances are Genco's involved in transporting it somewhere.
And the scale we're talking about is pretty substantial, isn't it? Their fleet size seems quite large.
Oh, definitely. The fleet composition tells a lot about their reach. According to the recent reports we looked at, their fleet includes 44 dry bulk vessels, and the total carrying capacity is huge, over 4.6 million deadweight tons, or DWT as it's known. To break that down a bit, they operate 17 Cape-sized dry bulk carriers. These are the absolute giants, typically hauling vast amounts of iron ore and coal on those long-haul routes.
The really big stuff, then.
Exactly. And complementing those, they have 15 Ultramax carriers and 12 Supermax carriers. These are more mid-sized vessels, offering greater flexibility for different cargo sizes and, importantly, access to a wider range of ports. So this kind of balanced fleet lets them cater to a pretty broad spectrum of customer needs and trade routes.
That is a significant fleet. And what about the age? The average age is reported around 10 years. What does that tell us in this industry?
Yeah, 10.0 years on average. Now, that might not sound brand new, but in shipping, a 10-year average can actually be a strategic sweet spot for a company like Genco. It suggests the vessels are generally modern enough, reasonably fuel efficient, compliant with current regulations, but without the massive price tag of a newly built ship or the higher maintenance burden of, say, a 20-year-old vessel. It points towards optimizing for performance and cost effectiveness.
Okay, makes sense. And their market presence. They're listed on the NYSE under G&K.
Right, the New York Stock Exchange.
Yeah.
And they actually make a point of stating in their filings that their stock is primarily and regularly traded on a U.S.-established securities market. That has tax implications, which they clearly want to emphasize.
Interesting detail. And
Right.
Geographically, they're headquartered in New York, but they've expanded, right?
Yeah, beyond the Park Avenue headquarters in New York. They've established offices in Singapore and Copenhagen. And this isn't just about, dots on a map. It's a really strategic move reflecting that shift towards more active commercial operations we'll talk about. Being physically present in major shipping hubs in Asia and Europe lets them execute their commercial strategy much more effectively, being closer to the cargo flows and customers.
Okay, so that sets the stage. Let's dive into their strategic playbook. What's the big picture goal driving Genco's decisions?
They stated very clearly in their filings, the overarching goal is, and I quote, to manage and expand our fleet in a manner that maximizes our cash flows from operations. So everything really orients around generating cash. That's the compass guiding their strategy.
Maximize the cash flow. Okay, and how do they structure that? They outline 5 key pillars, is that right?
That's right. 5 key pillars that really form the foundation. Think of them as the core principles for their operations and long-term plans. First, it's all about maintaining a high-quality fleet, top-tier operations. This means their ships have to meet or even exceed pretty stringent industry standards, and crucially, the requirements of the companies chartering them. This involves really rigorous maintenance programs, which they mostly outsource to well-regarded third-party technical managers. Names like Wallem, Anglo-Eastern Group, Synergy Marine Group come up. These firms handle the day-to-day technical side, keeping the vessels ready to go.
Makes sense. A reliable fleet is table stakes. But how do they actually use that fleet to make money? That brings us to their second pillar, the shift in commercial strategy.
Exactly. This was a big change for them. Back in 2017, they moved away from what they called a tonnage provider model, basically, just acting like a landlord running out ships, to a much more active commercial approach.
Okay, and what did that shift actually mean in practice? What was the impact?
The whole point was to improve their margins and significantly grow their direct customer network. It meant getting more involved, fixing more vessels directly on spot market voyage charters where they get paid per ton of cargo moved, or a lump sum for the trip. They also started doing more contracts of affreightment directly with the cargo owners.
So, less passive renting, more active trading of their shipping capacity.
Precisely. They believe this active platform gives them much more flexibility to react to changing market conditions. It helps improve operational efficiencies too. For instance, they can look for arbitrage opportunities, maybe using their vessel positions to charter in third-party ships for specific legs, or even reletting cargo commitments they have. Right now, their deployment strategy is definitely weighted towards these shorter-term fixtures. It gives them optionality, the ability to quickly capture upside in a rising market, but they're constantly watching the market, looking for chances to lock in longer charter periods or join vessel pools if the conditions seem right.
That optionality sounds good for capturing market highs, but does the focus on short-term deals mean they might miss out on locking in steady income when longer-term rates are favorable?
That's the perpetual balancing act in shipping, isn't it? Short-term flexibility versus long-term predictability. Genco's current strategy suggests they feel the benefits of being agile and capturing spot market premiums outweigh the security of longer fixed-rate contracts, at least for now. And this active approach directly feeds into their third pillar, strategic fleet expansion.
Right, growth. But not just buying any ship.
No, it's very selective. They aim to acquire additional modern, high-quality, and importantly, fuel-efficient dry bulk vessels. And the key criterion they state is that any acquisition must be accretive to cash flows. It has to boost the bottom line pretty much immediately, not just add tonnage for the sake of it. They do acknowledge this might require taking on more debt or issuing equity, which obviously brings its own financial considerations and risks.
And with all this activity, keeping costs down must be absolutely critical, especially with market volatility.
Absolutely. Pillar number 4, low cost, highly efficient operations. A big part of this is still outsourcing the technical management, as we mentioned, but importantly, their internal management team keeps a very close eye on the operating expenses these third-party managers incur. Strict cost control. They also benefit from economies of scale by operating sister ships vessels with almost identical designs. That helps streamline maintenance, spare parts, crew familiarity, things like that. Interestingly, they also mentioned they might explore using other third-party managers or even potentially bringing technical management in-house someday. So they're always evaluating the best operational setup.
Okay, and the fifth pillar, it's about reputation.
Yes, capitalizing on their management team's reputation. In shipping, reputation is currency. It's about leveraging their track record for high standards, performance, reliability, safety. This is crucial for building and maintaining strong relationships with the major international charterers, the big cargo providers. These companies want reliable partners. This strong reputation also helps with shipyards, vendors, and critically financial institutions. Being seen as a well-run, reliable company is a big plus when negotiating loans or credit lines. It signals creditworthiness.
Got it. Now let's get a bit more granular on how they actually earn money from these ships. You mentioned time charters and spot market voyage charters. Big difference between them, right? Especially regarding fuel.
Huge difference, and it's critical to understanding their risk exposure. With time charters, the customer hiring the ship for a set period typically pays for the fuel, the bunkers. How it works is Genco sells the fuel on board to the charterer at the market rate when the charter starts, and then buys back whatever's left at that same initial rate when the ship is redelivered. These deals often have flexible durations, say 4 to 6 months after delivery, allowing some leeway for the final voyage. But here's a key risk factor for Genco's revenue. If a vessel goes off hire, maybe due to a breakdown or something for more than 30 consecutive days, the charterer usually has the option to just cancel the contract. Uptime is paramount.
Okay, so the charterer pays for fuel on a time charter. What about the spot market voyage charters?
That's the opposite. On spot market voyage charters, Genco, as the ship owner, generally bears the cost of fuel. And fuel is a major operating expense. One of the reports noted they had 30 vessels operating on these spot voyage charters at that time. That's a significant chunk of the fleet where they're directly exposed to fuel price swings. As we said, their strategy currently leans towards these shorter-term spot fixtures. It gives them that market optionality, but it also means higher direct exposure to potentially volatile fuel costs, which they might not always be able to pass on fully to the customer.
Right. So understanding who fits the fuel bill and the risk of vessels going off higher, those are really crucial details for figuring out their actual profitability day to day. A constant balancing act, like you said. Okay, let's move on and get a closer look at the actual ships in Genco's fleet and how they've been managing them. The sources give pretty specific details, right? Listing individual vessels.
Yeah, they do. You can see names and specifics, like the Genco Augustus, the Capesize built in 2007 with about 180,000 DWT capacity, or the Baltic Lion, another Capesize from 2012, similar size. These specifics aren't just trivia. They paint a picture of the fleet's backbone, its size, and the general age profile of these key assets.
But it's not a static fleet. The filings show they've been quite active in reshaping it, particularly around 2020, 2021.
Very active. It's clear there's been a strategic fleet renewal program underway. They haven't just been operating ships, they've been actively pruning and upgrading. We saw this clearly in 2020 when they agreed to sell some older, presumably less fuel-efficient vessel ships named Baltic Panther, Baltic Hare, Baltic Cougar. Those sales went through in early 2021. It was like a strategic clearing out.
And then came that really interesting vessel exchange deal around the same time. That seemed like a major strategic move.
It really was. That wasn't just swapping old for new. It was about changing the fleet's composition. Genco agreed to acquire 3 modern Ultramax vessels: the Genco Magic, Genco Vigilant, and Genco Freedom. And in return, they gave up 6 of their smaller, older, handy-sized vessels like the Genco Ocean and Baltic Cove. This was a significant step to modernize the fleet and definitely shift focus towards larger, arguably more efficient vessel classes like the Ultramaxes.
And the buying didn't stop there.
Nope. In 2021, they bought another Ultramax, the Genco Enterprise, a 2016-built ship. Notably, they paid for that one with cash on hand, which signals good liquidity at the time. And even more recently, to 2023, they acquired 2 more Cape-size vessels delivered in the 4th quarter. So these moves show a consistent pattern, shedding older, smaller tonnage and investing in modern, larger vessels, especially in the Ultramax and Cape-size segments. It aligns perfectly with that active commercial strategy, focused on maximizing cash flow from potentially higher-earning assets.
Okay, so this fleet renewal program, what was the explicit rationale mentioned in the documents?
The board of directors formally approved this strategy. The filings state the rationale was primarily about divesting older, less fuel-efficient vessels. The goals were pretty clear: streamline and modernize the fleet for better long-term competitiveness, and also, increasingly important, to better meet current and upcoming environmental regulations. Fuel efficiency is key there. And as we noted, this has led to that visible shift in fleet makeup: fewer Handymax handy-size, more Ultramax and Cape-size. It suggests they see better earnings potential or economies of scale in those larger segments.
And selling ships isn't just about getting cash in the door, right? There are accounting implications, especially if the market value isn't great.
Exactly. This is where impairment charges come in. If Genco decides to sell a vessel, or even just classifies it as held for sale, they have to compare its carrying value, what it's worth on their books, to its estimated fair market value. If the market value is lower, they have to record an impairment loss. The document specifically mentions significant impairment losses in 2020 related to 15 Supramax vessels, and the Genco Charger vessel had impairments back in 2019 too. This really highlights how fluctuations in vessel market values, often driven by charter rates, can directly hit their reported financial results.
And what about the cash they get from selling? Is it always freely usable?
Not necessarily. If the vessel being sold was used as collateral for a loan, the proceeds might be classified as restricted cash. The Genco Provence sale in 2021 is cited as an example. The cash received had strings attached. It had to be used either to help finance a replacement vessel or to prepay the loan associated with the sold ship. Lenders did grant them extensions on using these funds, but it shows that even cash from sales isn't always immediately available for general corporate purposes or dividends. It can be tied up by debt agreements.
Okay, let's switch to some operational metrics. These numbers give us a sense of efficiency. Available days for the fleet were around 21,000 in 2019, down a bit from 2018.
Right, available days is the theoretical maximum. More telling is operating days, the days vessels actually earned revenue. That was just over 20,500 in 2019, down about 6.3% from 2018. And this feeds into fleet utilization, which is basically the percentage of time the ships were working. The fleet average was 97.5% in 2019. That sounds high, and it is, but it was actually a slight decrease from 98.5% in 2018. So small dip in overall operational tempo, or perhaps slightly more off-hire time for repairs or positioning. Individual classes varied though. Capesize hit 98.4%, Ultramax 97.4%, Supermax 97.3%. Interestingly, Handymax was at 100% utilization in 2019, which is impressive. Okay, now costs. Daily vessel operating expenses, DVOE. That saw a pretty big jump between 2021 and 2022, right? From about $5,400 a day to over $6,100. Yeah, that's almost a 15% increase year over year, which is significant.
Right.
The filings point to a few key drivers for that 2022 increase. Higher crew-related expenses were a major factor that's been a challenge across the shipping industry. Also, increased repair and maintenance costs, partly linked to transitioning vessels to their GSSM technical management venture in the first half of 2022. Things like initial stocking of stores and spare parts also played a role, plus just general inflationary pressures hitting everyone. Genco measures DVOE over 12 months to smooth out short-term spikes and get a better comparison.
Right, and those technical management fees paid to the third-party firms, they seem to fluctuate quite a bit.
They do, around $7.6 million in 2019, $8 million in 2018, then down to $5.6 million in 2021, even lower to $3.3 million in 2022, before ticking back up to about $4 million in 2023. These shifts likely reflect changes in the fleet size being managed externally, maybe renegotiated contract terms, or possibly the specific scope of services included in those fees each year.
And finally, general and administrative expenses, G&A. Those seem to be on a steady upward path.
Generally, yes. They went from about $23 million in 2018 to $24.5 million in 2019, mostly due to higher compensation costs, the filings say. Then roughly flat in 2021 at $24.5 million, up to $25.7 million in 2022, and then it jumped to nearly $28.3 million in 2023. A key part of that recent increase is the non-vested stock amortization expense, basically, the accounting cost of share-based compensation. That component alone grew quite a bit, from about $2.3 million in 2021 to over $5.5 million in 2023. This suggests an increasing use of stock awards as part of their overall compensation packages.
So broadly speaking, operational and administrative costs are creeping up, which means Genco really needs that active commercial strategy and efficient fleet management to work well, ensuring revenues grow faster than these expenses, especially given their exposure to the spot market's ups and downs.
Okay, let's dive into the financials properly now. Revenue is obviously key. Looking at their total voyage revenues over the last few years, it's been a real roller coaster, hasn't it? It really shows that shipping cycle. Absolutely. The numbers tell the story. About $367.5 million in 2018, up to nearly $390 million in 2019. Then, a dip in 2020, likely pandemic, related down to around $355.6 million. But then a huge rebound in 2021, jumping to over $547 million. Then it moderated slightly to about $537 million in 2022, before a more significant drop back to roughly $383.8 million in 2023. Classic cyclical industry pattern.
And that total revenue figure breaks down into different types, lease revenue and spot market revenue.
Exactly. And that spot market voyage revenue, where Genco usually pays for fuel, has seen some major swings itself. It went from $199 million in 2018 up to $281 million in 2019, then dipped slightly to $277 million in 2020. This really underscores how that strategic shift towards more active commercial management and spot market exposure directly impacts their top-line performance, making it potentially more volatile, but also offering higher upside in strong markets.
And who are their customers? Is there a lot of concentration risk there?
Well, they deal with a fair number of customers. In 2021, they got all their voyage revenue from 139 different customers. That number was 166 in 2020 and 170 in 2019. So it's reasonably diversified, not reliant on just one or two players. But they do mention managing credit risk, actively doing evaluations, requiring letters of credit or guarantees sometimes. Standard practice, but still important given the sums involved.
Now, something you touched on earlier, impairment. How sensitive are they to charter rate changes when valuing their own ships?
Extremely sensitive. The filings explicitly state that future charter rates are the most significant and volatile input for their vessel impairment analysis. Their methodology is interesting. They use current contracted rates for days the ship is already fixed. But for future unfixed days, they estimate a daily time charter equivalent. This estimate is based on the most recent 10-year historical average for one-year time charters for that specific vessel class, but then they adjust it based on current market sentiment. It's a mix of history and current conditions.
A blend, okay. But how much does it take for rates to drop before they have to write down asset value?
This is where the sensitivity really shows. Older vessels are more vulnerable because they have fewer years left to potentially earn back value if rates improve. The documents give specific examples from late 2019. For their Cape-sized vessels, Just a 9.1% decline from that 10-year historical average rate would trigger an impairment charge. And for their Supermax vessels, it was even tighter. Only a 3.8% decline was needed to trigger impairment.
Wow, 3.8%. That's incredibly sensitive. It means their balance sheet value can swing significantly based on relatively small market moves.
Precisely. It really drives home the razor-thin margins and the intense market exposure they manage. And we saw this play out in the numbers. They booked a huge impairment charge of $208.9 million in 2020, hitting 20 Supermaxes and 10 Handysizes, and another $41.7 million in 2023. Interestingly, no impairments were recorded in 2021 or 2022, which were stronger market years. It shows how directly market conditions translate to their reported asset values and profitability.
Okay, let's talk debt. Managing debt is obviously crucial for long-term health. They used to have quite a few different credit facilities.
Yeah, the history shows several large ones, a $495 million facility, $193 million, a $498 million, plus an older 2014 term loan. A bit complex to manage, you'd imagine.
So what changed? There was a big refinancing effort.
Yes, in August 2021, they closed a new $450 million credit facility. The main goal was to refinance a large chunk of that existing varied debt. They stated aims were to get more flexibility, hopefully better terms, and importantly, lower their overall cash flow break-in rates, the point at which they start making actual cash profit. It was a major strategic financial restructuring.
And did it help reduce their overall debt burden?
Initially, very significantly. As of December 31, 2020, under the old main facility, they owed over $334 million. But December 31, 2022, after the refinancing and active repayments, their total outstanding debt was down to $171 million. That's a huge 62% reduction from the start of 2021. Really aggressive deleveraging. However, the picture evolved again. As of December 31, 2023, their outstanding debt had increased to $200 million, now under a larger $500 million revolving credit facility. This suggests maybe a shift towards using revolving credit more actively for working capital or investments, while keeping term debt lower.
And a lot of this debt is floating rate. What's the risk there?
Yes, significant floating rate debt exposure. This means their interest costs fluctuate with changes in benchmark rates, historically LIBOR, now increasingly SOFR, Secured Overnight Financing Rate. You can see this in their effective interest rate, 3.22% in 2021, 3.71% in 2020, up at 5.31% back in 2019 when rates were generally higher. The risk, especially with the whole LIBOR transition still playing out, is that if these benchmark rates rise significantly, their interest payments go up, directly hitting cash flow.
So to keep lenders comfortable, they have to meet specific financial targets or covenants, right?
Exactly. These are crucial guardrails. The specifics change with each facility, but looking at examples from the previous main loan gives a good idea, and they're likely similar now. There's a collateral maintenance test. The appraised value of the ships pledged as collateral has to be worth at least 135%, where it was 140% for the newer facility as of late 2022 of the outstanding loan amount. If they dip below, it's a default, but they usually get 30 days to fix it by adding more collateral or paying down the loan before it becomes a more serious event of default. So vessel values directly impact their loan compliance.
What other kinds of covenants are typical?
Things like minimum liquidity. They need to keep a certain amount of unrestricted cash on hand, defined as the greater of $30 million, or 7.5% of their total debt. Also, minimum working capital, basically ensuring current assets, excluding restricted cash, cover current liabilities, excluding the current chunk of long-term debt. It needs to be above zero. And a debt-to-capitalization ratio cap, often around 70%, limiting how much leverage they can take on relative to their total capital structure. These keep them financially disciplined.
One thing noted is they keep all their cash with just 4 banks. Is that a risk?
It's noted as a concentration of credit risk. While managing cash across fewer institutions is simpler, it means if one of those banks were to fail, the deposits likely wouldn't be fully insured. It's a counterparty risk, albeit probably a low probability one with major banks.
And are they using hedging tools to manage some of these financial risks, like interest rates or fuel prices?
Yes, they do. They use interest rate cap agreements to limit their exposure to rising interest rates on that floating rate debt. As of late 2023, these covered a notional amount of $50 million. They also use bunker swaps and forward fuel purchase agreements to hedge against fuel price volatility. However, the filings specifically state these fuel hedges don't qualify for special hedge accounting treatment. This means the gains or losses on these derivatives flow directly through their income statement each period, which can actually make their reported earnings more volatile, even if the underlying economic risk is being managed.
Okay, so how does all this financial maneuvering translate into cash flow and their dividend policy?
Looking at operating cash flows, there was a noticeable drop from about $189 million generated in 2022 down to roughly $92 million in 2023. The explanation given is mainly lower net revenues earned across their fleet, plus some working capital changes. This is partly offset because they spent less on dry docking in 2023 compared to 2022.
And this ties into their value strategy announced back in 2021 that had 3 pillars.
That's right. Announced April 2021, focused on 3 things: compelling dividends, financial deleveraging, and growth. We saw the deleveraging in action. They paid down a massive $203 million of debt in 2021, plus another $75 million in 2022. Getting that debt down to $171 million by end of 2022 was a huge step on that pillar.
A very clear focus on strengthening the balance sheet. How did the dividend part of that strategy play out?
The first dividend under this new strategy was paid in Q1 2022, based on Q4 2021 results. And they were substantial initially. From Q4 2021 through Q4 2022, they declared cumulative dividends totaling $3.24 per share. The policy adopted in April 2021 uses a specific formula linked to financial performance starting Q1 2022. And this is crucial, it's not automatic. Payment depends on having legally available funds, complying with laws, and importantly, their credit agreements. And the board explicitly deciding each time that paying the dividend is in the best interest of the company and shareholders.
So definitely conditional. What are the main restrictions that could prevent a dividend payment?
Several key ones. They can't declare a dividend if an event of default under their loans has happened or would happen because of the payment. They also have to be able to meet all their financial covenants on a pro forma basis after paying the dividend. And fundamentally, Marshall Islands corporate law prevents paying dividends if the company doesn't have sufficient surplus or if the payment would make the company insolvent. Financial health and loan compliance come first.
Got it. And just quickly, they also use share-based compensation, RSUs, and options.
Yes, standard practice. They use restricted stock units, RSUs, and stock options as incentives. The example given is over 200,000 RSUs awarded in Feb 2022, vesting over 3 years. Some older warrants related to past restructuring expired in 2020 and 2021. It's a way to align employee and executive interests with shareholder value.
All right, let's shift focus now to the significant risks Genco faces. Operating globally in shipping is inherently risky, and their own reports lay these out quite clearly. First up has to be market and economic volatility.
Absolutely fundamental. The dry bulk market is notoriously cyclical. If the supply of new ships being built outpaces the demand for carrying cargo, which happens periodically, freight rates and charter hire rates can plummet. If market conditions really deteriorate and stay weak for a long time, Genco could find it difficult to employ its vessels profitably, or maybe even find work for them at all.
And it's not just ship supply demand, it's the whole global economy, right?
Exactly. Broader economic downturns, political instability, social unrest, unexpected shifts in flight capacity worldwide, any of these can materially hit their business, their results, cash flow, and as we just discussed, even their ability to pay dividends. Trade barriers are another specific risk mentioned. Increased protectionism or trade restrictions, especially involving major players like China, can directly cut dry bulk trade volumes. They even cited the example of past Chinese tariffs on U.S. soybean exports impacting demand. Even with trade deals in place, the risk of future tensions impacting cargo flows is always there.
Fuel price volatility must be a constant headache, especially with their spot market focus.
Huge headache. Since a big chunk of their fleet operates on spot voyage charters where they pay for fuel, they were directly exposed. If fuel prices spike, they might not be able to pass that full cost increase onto the customer, squeezing margins. While they mention things like charter expirations allowing repricing, the fluctuations are unpredictable and can lead to losses or just drain working capital. And as we covered in financials, interest rate risk is tied to this too. With significant floating rate debt, rising rates mean higher interest payments, hitting cash flow directly.
Okay, beyond market and economic factors, what about the physical operational hazards? Running ships around the world isn't risk-free.
Far from it. There's always the risk of vessel damage or even total loss. This could be due to mechanical failures, collisions at sea or in port, human error by the crew, cargo shifting or loss, or just plain bad weather like typhoons or major storms.
And the consequences of such incidents.
They can be severe and wide-ranging. Injury or death to crew members or others, heavy costs for repairs and salvage, significant revenue loss while the ship is out of service, off-hire, damage to the cargo they're carrying. Environmental damage is a big one, especially potential spills, higher insurance premiums afterwards, damage to their reputation and customer relationships, and delays that ripple through the supply chain.
And the world itself presents risks, geopolitical instability.
Definitely. War, terrorism, piracy. These are real threats in certain shipping lanes. Genco acknowledges their vessels operate in potentially dangerous areas. The South China Sea, Arabian Sea, Indian Ocean, Gulf of Aden off Somalia, Gulf of Guinea off West Africa, the Red Sea. Piracy remains a concern in some zones. Rising tensions between major powers like Iran, US, or US-Russia can create broader economic instability and disrupt shipping patterns or increase insurance costs drastically for certain regions.
There are also security regulations stemming from past events.
Yes. Post-9/11 measures like the U.S. Maritime Transportation Security Act, MTSA, and related Coast Guard rules impose pretty stringent security requirements on vessels calling at U.S. ports, essential for safety, but they add layers of operational complexity and cost. And we saw clearly with COVID-19 how public health threats can impact them. Pandemics can crush industrial activity, reducing demand for commodities and hitting dry bulk rates. They can cause delays at ports, force ships off hire due to quarantines, make crew changes incredibly difficult, and even delay necessary dry dockings if shipyards are affected. Even payment processing could be delayed if shore-based staff are impacted.
That covers a lot of ground. What about less obvious operational risks, like smuggling?
Even that is mentioned. Vessels calling at ports in certain regions, South America is mentioned as an example, face a risk of drugs or other contraband being hidden on board, often without the crew's knowledge. If found, Genco could face government claims, hefty fines, or even have the vessel detained for extended periods, all impacting revenue and operations. Labor is another point. They rely on third parties to employ their crews. Any labor unrest or strikes involving those crews could disrupt their vessel operations. And cybersecurity, increasingly critical. Genco relies on IT systems, some managed by third parties, for everything from navigation to payroll. These systems are vulnerable to cyber attacks, malware, ransomware, but also simple employee error, power outages, or natural disasters. An incident could lead to data breaches, operational shutdowns, legal claims, penalties, and serious reputational damage. They state they have policies to manage this, but it's an ever-present threat.
Okay, so layers upon layers of operational risk. Now let's talk about the regulatory environment, particularly environmental and safety rules. That seems like a huge area of complexity and cost.
It absolutely is. Their business is profoundly affected by a constantly evolving web of international conventions, like from the IMO, the International Maritime Organization, regional rules, like from the EU, and national or even local laws, like in the US. It's incredibly difficult, they note, to predict the exact future costs of compliance, or how new rules might impact vessel values or even shorten their useful lives. New regulations could significantly increase cost or limit where or how they can operate.
Greenhouse gas emissions must be a major focus now.
A huge focus globally. While international shipping emissions aren't directly covered by the Kyoto Protocol or Paris Agreement framework right now, negotiations are ongoing. Restrictions might well be included in future treaties. Any significant climate control legislation or new regulations could require substantial and currently uncertain spending on new technologies or operational changes. Climate change itself, they note, could indirectly affect them through sea level changes or more extreme weather.
We saw a big regulatory change recently with the IMO 2020 sulfur rules. How did Genco handle that?
That was a massive shift, mandating a reduction in sulfur emissions from 3.5% down to 0.5% from January 1st, 2020. Genco's approach was twofold. They invested heavily in installing exhaust gas cleaning systems, commonly known as scrubbers, on their 17 Capesize vessels. These allow them to continue burning the cheaper, high-sulfur fuel oil while meeting the emission limits. This installation was completed by the deadline. For their other vessels without scrubbers, they had to switch to using more expensive, IMO-compliant, low-sulfur fuels.
Did installing scrubbers solve the problem, or are there still risks associated with them?
There are still risks. The economic benefit depends on the price difference, or spread, between high sulfur and low sulfur fuel remaining wide enough to justify the scrubber investment and operating costs. If that spread narrows significantly, the payback period gets longer or might disappear. There's also the risk of compliant low sulfur fuel costs rising more than expected, or it being unavailable in certain ports. And crucially, there's regulatory risk around the scrubbers themselves, particularly open-loop scrubbers, which discharge wash water. Some countries and ports are already restricting or banning this discharge within their waters, which could limit where those scrubbed ships can trade or force them to switch to low-sulfur fuel anyway in those areas.
So compliance is complex. What other major environmental regulations are they dealing with?
NOx emissions, nitrogen oxides are another area under IMO Annex 6 and EPA rules. There are increasingly stringent tiers of NOx standards. Tier 3 standards, the strictest, apply to ships built after early 2016 operating in specific emission control areas, ECAs, like North America and the U.S. Caribbean. New ECAs in the North Sea and Baltic Sea will apply Tier 3 from 2021 onwards for new ships. Genco states they don't currently own vessels subject to Tier 3, but if they acquire newer ships or regulations change, that could mean additional costs. They are compliant with the earlier Tier 1 SU standards.
And ballast water management, that's been a big topic too.
Yes, very significant. Rules from the EPA and U.S. Coast Guard, now largely consolidated under the Vessel Incidental Discharge Act, VITA, require ships to have systems installed to treat ballast water before discharge to prevent the spread of invasive species, or they need other approved disposal methods. Genco have been actively installing these ballast water treatment systems, BWTS. They reported having them on 43 vessels already and were in process for others. The cost isn't trivial, estimated around $900,000 for a Capesize and $600,000 for a Supramax, varying by ship specifics and whether it's done during a scheduled dry docking. Failure to comply could lead to substantial costs or, critically, prevent ships from entering U.S. waters, which would severely limit their trading potential.
And it's not just environmental regs, but fundamental safety codes too.
Absolutely. Core safety rules like the SOLAS Convention, Safety of Life at Sea, get amended, for instance, regarding safe manning levels or emergency drills. Genco states they believe they comply. Then there's the ISM Code, International Safety Management Code. This requires shipping companies to have extensive safety management systems covering both safe operations and pollution prevention. Non-compliance can have dire consequences: increased liability in case of accidents, loss of insurance coverage, being denied access to ports, or even having the vessel detained. Genco states all its vessels are ISM Code certified, but maintaining that certification requires continuous effort and audits.
What about region-specific rules, like from the EU?
Yes, the EU has its own layer. Directives impose potential criminal sanctions for illegal ship source pollution discharges. There's also a specific EU regulation, 210757-57, requiring monitoring, reporting, and verification, MRV, of CO2 emissions for larger ships calling at EU ports. This adds administrative burden and expense. And finally, underlying all of this is vessel classification. Every ship has to be maintained in class by a recognized classification society like ABS, DNV, Lloyd's Register. This involves regular surveys, annual, intermediate, major dry docking surveys every 5 years, and special surveys. Failing to maintain class means the ship can't legally carry cargo, can't get insurance, can't trade. It would also likely violate their loan covenants. It's absolutely fundamental to being able to operate.
Wow. It really paints a picture of a regulatory minefield on top of all the market and operational risks.
It really does. It demands constant investment, monitoring, and adaptation just to stay compliant and operational.
So beyond operations and regulations, there are also corporate, legal, and financial exposures specific to Genco's structure and business.
Yes, several are highlighted. First, Genco itself is a holding company. This means its ability to pay its own debts, cover its administrative costs, and importantly, pay dividends, depends entirely on receiving distributions cash from its actual ship-owning subsidiaries. The health of those subsidiaries is paramount.
There's also a specific tax risk mentioned for U.S. shareholders, the PFIC risk. Can you explain that?
Right, Passive Foreign Investment Company, or PFIC. This is a complex U.S. tax rule. If a foreign corporation meets certain tests related to passive income or passive assets, it can be classified as a PFIC. If Genco were deemed a PFIC, it could result in pretty unfavorable U.S. federal income tax consequences for its shareholders who are U.S. taxpayers. It can change how dividends and capital gains are taxed, often less favorably. Genco argues they shouldn't be a PFIC because their income from chartering vessels, both time and spot charters, should be considered services income from actively operating a business, not passive rental income. However, they explicitly state there's no guarantee the IRS or courts would agree with their position or that their situation won't change, making them a PFIC in a future year. It's an ongoing risk assessment for them and their investors.
Interesting. And their place of incorporation, the Marshall Islands, does that carry any specific implications?
It's mentioned that the Republic of the Marshall Islands, while a very common jurisdiction for shipping companies, has a less developed body of corporate law compared to, say, Delaware in the U.S. This could make it potentially more difficult for shareholders to protect their interests in certain situations, as the rights of shareholders and the fiduciary duties of officers and directors might not be as clearly defined or extensively litigated as in some other jurisdictions.
What about currency risk?
Yes, that's always there for global companies. Genco's revenues are all in U.S. dollars, which simplifies things somewhat. However, a portion of their expenses, things like dry docking costs, often done in Asian shipyards, port charges around the world. Special survey fees can be incurred in other currencies. If the US dollar weakens significantly against those currencies, those expenses become higher in dollar terms, which could negatively impact their results.
And being publicly traded means stock price volatility is unavoidable.
Completely unavoidable. The market price of G&K stock can, and does, fluctuate based on a whole host of factors. Analyst reports, general investor sentiment about the shipping sector, news from competitors, overall industry trends, and of course broad financial, economic, or political shocks. Any of these can move the stock price, sometimes quite dramatically, independent of Genco's specific performance that quarter.
We also saw an example of legal risks having a direct operational impact, the Genco Constellation case.
Yes, that was a concrete example from late 2022. A subcharterer made a claim against the vessel, leading to its arrest, basically, being legally detained in port. This resulted in lost revenue for months while the legal process played out. Genco fought the claim and eventually settled it in early 2024, recovering damages and fees. But it clearly illustrates how legal disputes, even if ultimately won, can cause significant operational disruption and financial cost in the interim. And lastly, they include a standard but important disclaimer about internal controls over financial reporting. They acknowledge the controls have inherent limitations and might not prevent or detect all misstatements. It's a recognition that no system is foolproof and risks remain.
So we've really journeyed through the complex world of Genco Shipping and Trading. We've looked at their core strategy focused on cash flow, their active fleet management and renewal efforts. We've navigated their financial situation, the debt management, the dividend policy, and importantly, we've explored the vast array of risks they face: market, operational, geopolitical, regulatory, legal, financial. It's clear how a company like this has to balance immense global operations against highly volatile market forces and that incredibly complex, ever-shifting regulatory landscape.
Absolutely. What stands out from their filings is just how demanding this sector is. It requires constant vigilance, significant capital investment, and an ability to adapt quickly across so many different dimensions: economic, political, environmental, technical. The margins can be thin, and the global interconnectedness means shocks anywhere can ripple through their business.
Definitely not for the faint of heart, as you said earlier. So reflecting on all this for you, our listener, considering this constant churn of global trade dynamics, geopolitical shifts, and those relentless environmental regulations, what long-term investments, maybe in technology or different operational models, do you think would most effectively future-proof a dry bulk shipping company like Genco against the challenges we know are here and the ones perhaps yet to emerge? And thinking further, what unexpected ripple effects might those kinds of changes, maybe towards more automation, different fuel types, or data-driven trading, have on the broader global supply chain we all depend on? Something to definitely ponder. That's our deep dive for today.